Okay, good morning to everybody, and we're going to pick up from where we left off on Monday with talking about chapter 12. So the plan for today is I want to talk a little bit about some of the problems that you might expect to see on the exercises in the back of the chapter and whatnot. So I want to do that, and then I want to spend the back half of the class session talking about the exam itself. So that's, I think, the plan for today. So I know that on we've got some people on the live Zoom call. So does anybody have any questions at all about anything we talked about before we get going? So I want to talk about some of the questions and the problems that may come up. So the first exam is coming up. It's going to be covering chapters 10 through 12. So we'll get to that. But I do want to talk about some examples here of some problems we've got. So I think last time we ended off with some examples of the practice multiple choice questions. So let's look at practice multiple choice question number 11. And that was in the Crawford Company, the amount of predetermined overhead was 80% of direct labor. During this month, Crawford incurs 210,000 factory labor and which 180,000 is direct labor and 30,000 is indirect labor. So obviously the 210,000 is accounted for both in direct and indirect labor. Actual overhead cost incurred was 200,000. So one thing that we should point out is that very often you're going to have material here that's not really related to what you're needing. And so this idea of what's actual recorded is really not necessary in this particular question. And so the question here is the amount of overhead added to work in process should be what? Okay, so let's go back to what we talked about with regard to how we calculate estimated overhead, and which we call applied overhead. So applied overhead is this idea, this prejudged, pre-estimated, predetermined overhead rate, which is based on something. In this case, the driver here is labor cost. And we're saying that at some point in the past, we don't care when, the company decided that 80% of direct labor cost should be calculated as overhead. Okay, it's the way that we assign overhead, or in the term of art here, we apply overhead. So what's going on here is that we are looking at what. Now I'm going to try to do this in a second. This is practice multiple choice number 11. And so we got 80% times times what here? Times the incurred overhead cost, which is 180,000. Okay, so 180,000. So 80% times 180,000 is, it should be 144,000. Okay. And that should be the amount of overhead that is recorded. And again, what is this figure representing? It's basically representing the idea that we're trying to apply overhead, which are the indirect costs, to actual production. And we realize we've got difficulties in doing it. So we do it based upon some predetermined overhead rate. Okay. So that's really what's going on there. So, and to practice multiple choice 11, we've got the answer. We click on it, we will see that B, work in process inventory should be increased 144,000. Okay. So that's what's going on with that problem there. And this is a fairly similar type of example you might see throughout the problems and exercises. So for this week, remember that we've got the exam due on Sunday, but we also have the discussion exercises problems and bonus problems due this week as well. So try to keep that in mind. So a lot to do this week, and so kind of be aware of that. So okay, questions about that one? Let me kind of drop down here a minute to go to the practice exercises number 1. This is really a better problem that sort of gets us into the issue of trying to account for the flow of costs as they move along the production system. So remember what chapter 12 is talking about here. We're talking about unique projects of which we're trying to capture the cost and try to move them along from start to finish so that we can capture inventory cost and hopefully be able to judge whether or not this is a correct price to sell to the customer or not. So we've got an example here, and I really like this a lot because it kind of has a lot of what we are really intending to do here. So in this case, we've got a job order cost from Michael's company. And remember, job order cost sheet is really this idea of sort of capturing within a job all the costs itself. And whether or not we are capturing on a single sheet, piece of paper, or electronic record is really mostly irrelevant as long as we're sort of capturing it. So here's what's going on. So we've got this idea. We've got beginning direct materials, direct labor, and manufacturing overhead. So remember from accounting 1, when we have a beginning figure, it really ends up being the ending figure of some prior accounting period, okay? Because we start over as every accounting period begins. So in this case, we're asked really to do two things. What's the balance in the work in process on January 1st, if this is the only unfinished job? So we're assuming whatever this is, job, what is it, 92 is not done. So what is the balance in the WIP account, okay? And if manufacturing overhead is applied on the basis of direct labor, what is the overhead rate used each year? Okay, so let's do this. So, and I know that we've got sort of a handicap here because we've got the screen up, and I'm going to bring this up here in order to do this, but I want us all to sort of look at this and ask ourselves, what are we trying to determine here? So, all right, so what's the balance of work in process? Well, think about this. The balance of work in process is production cost, which is direct materials as of January 1st, 3925, direct labor 6,000, and manufacturing overhead 4,200. And so as a result, all of those are added together, and so we should have 14,125. Okay, those are just simply the figures added together to be work in process at the beginning of this period. Okay, so that part is fairly straightforward. So B is a little bit more complicated. It's manufacturing overhead applied on the basis of direct labor. What is the overhead cost used during the year? Okay, well this is a little bit more complicated. So remember, we talked about manufacturing overhead. What are we saying with regard to manufacturing overhead? It's applied based upon some driver, some activity that's going on. So if labor is the driver, labor dollars, because labor cost, not labor hours, not machine hours, not something else, then what is the factor that's going on here? In this case, I'm going to sort of leave the screen down a little bit so that we can sort of look at this a little bit more. So what is going on here? So if you think about this, all right, so there's really two questions within B here. Manufacturing overhead is applied on the basis of direct labor. What is the overhead used in each year? Okay, so let's go back to the prior year, okay? And remember, this job number 92, whatever it is, we don't really know, we don't care, but we know they've incurred 6,000 of direct labor and manufacturing overhead has absorbed 4,200. And we know that the driver of overhead application is direct labor cost. So in this case, we've got what, 4,200 that's been allocated to 6,000 of production. And so as a result, we get a variable 0.07 or 70%. And remember, we can simply move the decimal 2 points to the right to get 70%. 70%. Okay, so in the prior year, the overhead rate was 70%. Okay, basically because we know, and how do we know this? We know it because remember, this is all past activity, and we know that in this prior year we absorbed or applied 4,200 against a $6,000 of incurred labor cost. So as a result, 70%. The other question is though, what about the current year? Okay, so what about the current year? If we take, there are two different means by which we get the same answer here. And that is this. Okay, so if direct labor cost, not direct labor hours, not machine hours, not anything else, is the driver here. And if we take the manufacturing overhead applied, 6,375 divided by 8,500, or 3,000 divided by 4,000, we're going to get 75%. So As a result, we're getting a higher percentage applied of manufacturing overhead in relation to labor. And why is that? Well, we don't know. We don't know. We don't really, I guess, for our purposes, don't really care. But we know that we're going to have a higher application of manufacturing overhead for whatever reason. Okay. So that's really sort of the challenge here is the idea of saying, okay, why is manufacturing overhead changing? And we don't know, but we know that we can calculate it and we can get there. Okay. All right. So that's pretty example of some of the things you might look at on the this week's homework. And I want to kind of move on here a little bit. Any questions about that one? And before we move on. I want to do a couple more, and I do want to spend really most of the class session talking about the exam, which is this week, and talking about what's going on there. So I want to go down to exercise 12.7, and I'm going to scroll down here, and I'm going to have to, unfortunately, bring the screen up. So those of you watching on the screen are going to have to kind of follow along. This is 12.7, exercise 12.7, on page. Let me get to it here. 12:30. Okay, 12:7. All right, so exercise 12:30 on page 12:30. Okay, so what I want to do here is sort of record these events that are going on here because they're really relevant to what we're talking about here in chapter 12, and they also involve this sort of movement of costs are being accumulated, dropping it on inventory and then moving it out the door in terms of cost of goods sold. So I really think this is a pretty good example of what we're really trying to get at in this particular chapter. So in this case, we've got 8 different items that are going on here. So I'm going to sort of bring this up. And I know that this is not a perfect system because of the fact that we got recording going on, but I do want to talk about what's going on. So Crawford Corporation incurred the following transactions. So there's a purchase of raw materials, et cetera, et cetera. Okay. So I'm going to kind of break this up a little bit. And I'm going to search trade mass. Obviously, I can't have this on the screen while I do it. So, but I really like this question though, because it does a lot for, I think, for understanding of what's going on here. So let me get this. Okay, so in this question, and what I want to do is this. This is sort of a kind of a lead into a lot of what we do in this accounting course is the idea of creating sort of accounts. Accounts are really sort of totals, summation totals, where we categorize certain items, whether they're cost, revenue, expense, whatever. And so I'm going to do this in this particular case. I want to say, in this question, this is exercise 12.7, and I want to categorize manufacturing costs first of all. Now remember, manufacturing costs, we've talked about this before, really composed of different elements, okay? And I want to sort of break out direct materials into raw materials, okay? Now raw materials can go both directions. They can be direct materials, which are captured in direct costs, or indirect costs. And so we'll have a way to deal with that here. So I want to go with raw materials first. And we go factory labor, which in this case, this is a manufacturing operation. And in terms of labor, remember that labor can be either direct cost that goes directly in the inventory, which is what we think about when we think about direct costs. Those inventoriable costs, or they can be indirect labor. So we got like both elements there. And then I want to talk about manufacturing overhead. Okay, so those are the 3 main elements. And we'll sort of bring that down. Okay. So remember, and one of the methodologies that we use is this idea that we're absorbing cost. As we move products along, we're sort of absorbing cost throughout the production process. And so we're absorbing them, first of all, into a working process as goods which are not yet finished, but nonetheless being accounted for because it's an inventory account. And then once they're finished, they move their way over to finished goods. And then once the goods are sold, they move all the way out the door to cost of goods sold. Okay. And in this particular case, we've got 8 different scenarios and we're going to sort of track here, and let's do that. So number one is purchase raw materials on account for 46,300. Well, first of all, I'm going to try to make this as easy to see as possible. So number one is we got 46,300 of materials that are purchased, and we don't really care that it's on account or cash. It really doesn't make any difference. The only thing we're really trying to account for here is the idea that 46,300 of raw materials are required. Okay? So that's the first transaction. So for those of you watching sort of at home here, we gotta come look back here. So number two, raw materials of 36,000 requisitioned to the factory. Analysis requires or indicates that 6,800 is classified as indirect materials. Okay, well, we know that 36,000 is coming out here, okay? But we also know that some of this is indirect materials. So let's think back about what indirect materials go to as a pending account before it moves its way to work in process and building before finished goods. So indirect materials, we know we're given here is 6,800. So if you take the requisition of 36,000 and subtract the 6,800 of this, which is allocated toward indirect materials, then what is the balance of that? It's 29,200. So 29,200 then is deducted in this case, and I'll put a little brackets here. Those direct materials, and those go where? Those go directly over to work in process. Okay, and the reason for that is those are direct. That's a direct acquisition cost. Okay, but it was 36,000 was requisition, so it must be 6,800 is going to go to somewhere, and so as a result, we're going to capture 6,800, and we're going to put that in manufacturing. So notice what's going on. By the way, you know, as accountants, we like to put negative values in parentheses, and so these things balance out. Every entry everywhere in accounting is going to be balanced out. So on both sides of the equation. So in this case, we have 36,000 is accounted for, both in terms of direct materials, which go to WIP, work in process, and indirect materials, which go to manufacturing overhead. Okay, that's the second transaction. The third one is this: factory labor costs were incurred at 59.9. Okay, so we don't have dates here, and sometimes these summaries require we put dates. We're just going to go with numbers here. So 59.9 is incurred in terms of direct labor. So that goes over here, and I'm going to try to keep these columns as straight as possible here. It's maybe a little bit difficult, but so 59.9 is direct labor costs or labor costs. So 59,900, and of that, what are we told here? Some of that is indirect labor. Remember what indirect labor is? Indirect labor are those costs which really can't be absorbed into the attachment to the product itself. Security guards, salaries, plant overhead salaries, inspectors and whatnot. So in this case, we're saying 5,900 was indirect labor. So of this, 5,900 is going to be considered indirect labor. So we're going to capture that, and we're going to move that over here to manufacturing. And the other difference is 54.9, or sorry, 54, which we're going to put over here in work in process. So remember, what we're doing here is we are capturing costs, inventorying them as they apply to direct labor.
That's a good question.
Sure.
So the bonus problem was pretty similar to this.
Yeah.
For this week, and the way that it's set up was, so when I did this with the direct labor and factory labor, the way that it was kind of set up was that there were some project costs that were incurred prior month, some in the current month. And it only wanted the ones from the current month in this. And I didn't understand that, because if this is based on the job, shouldn't it include all the costs from that entire job and not just the ones from the current month?
Well, if it's a prior month, it should be carried over. Was it included in the WIP account? Because prior costs, I mean, it depends on when they cut off, what the accounting period was. So
That must be what it is, like that, they were supposed to, but it didn't mark those as wrong, and I didn't put it in. But I wonder if they were supposed to go in with and not in direct labor.
Yeah, I don't know, yeah, maybe send me an email on that.
Okay.
Look at that, so, yeah.
Yeah, I'll take another look at it.
Yeah, take a look at that, we'll see, we'll sort it out, so.
Okay.
Okay, all right, so in this case, what do we have here? We have assignment of $59,900 of labor cost, 54,000, which is direct labor. And we can think of, and by the way, we put this in the WIP account because it's direct labor, it's attached to the product itself. And 5,900, which balances this transaction, is, you know, things like incidental labor and labor that's not really attached to the product itself, so. And then number 4 is, let me see here. Time tickets. Okay, and so I kind of absorbed this here. So time tickets. I kind of was working in here. So number 4 is time tickets. So what are we talking about time tickets, which really aren't a thing anymore? It's a physical item which really doesn't exist anymore. But in this case, we're allocating labor between direct and indirect. Okay. All right, what's the next one? Number 5, manufacturing overhead and costs incurred were $80,500. Okay, this is a big one. This is important one. And it kind of goes to the idea that when we talk about overhead, we're talking about the idea of applied overhead. Now remember, if we don't put a positive or negative sign around this, we're assuming it's a plus. In parentheses or a negative. That's just kind of the way that we do things in accounting. So in this case, we're saying, what do? We dropped $80,500 on manufacturing overhead. Where did that number come from? Well, we applied it, okay? And when I say we, we're talking about the company itself. And they're saying, whatever the driver was, we are dropping it onto overhead based upon some predetermined driver. Now remember, overhead is problematic in the sense that we don't really know what it's going to be at the end of the year. And so we sort of estimate it, and historical cost is one pretty good and useful measure, but we really don't know. So we're putting it onto manufacturing overhead. Notice that it's not inventory yet, okay? And notice also that we are moving over things like indirect labor to this and indirect materials to this because they're sort of pending while we assess the issue of what to do with the overhead, okay? And we will take actual and compare it to the estimated, okay? And by the way, the term estimated and applied on the same thing, okay? All right, what's next here? So we've got manufacturing overhead was applied at 150% of direct labor, okay? So what does this mean? All right, so if we take item number 6 here, we're saying we're applying overhead. So what the driver was, we're saying 150% of direct labor is accumulated as manufacturing overhead. So we're going to deduct 81,000 from this account here. And we're going to move that over to now work in process. And why are we doing this? It's because we're sort of recognizing that, okay, we've incurred these costs. 150% of direct labor is now manufacturing overhead. So we're going to apply it. This number may not be right. And we're going to talk about this idea of when we over or under applied it, what we do about it. And this idea is that we're trying to do our best here and trying to over or under apply. Okay. And then we've got completed goods, and completed goods costing 88,000 or completed and transferred to finished goods. Okay. So this is number 7. I believe number 7. Let's see. Goods costing 88,000 or completed and transferred. Okay, so we've got some goods that are done and they're transferred. So what are we doing here? We are coming all the way down here and we're taking 88,000. And by the way, these are the firm's costs. So this may not be one job at all that we're capturing here. But we're saying 88,000, which we'll write this here. 88,000 are done. And we're going to do what? We're going to move them over here to cost of goods sold. Because now they are sold. Okay. That's 88,000. Completed and done, and then moved to finished goods. Okay. And then finally, the last one here is finished goods costing 75,000 were sold, and so as a result, 75,000 are done, and we're going to record those as a negative. And these numbers don't have to sort of match here because they're not really required to be matched, because they're all the projects this company has going on. Okay? So that's kind of an idea of what's going on in number. This is exercise 12.7, page 1230 of the e-text. Okay, so any questions about that one? The idea is we're moving left to right here. We're sort of capturing costs, and we're sort of moving them from finished goods all the way. And by the way, I probably should move to finished goods before cost of goods sold. But that's really the issue here: is moving these goods all the way along the production process. Okay. Okay. I want to do a couple more here, and I think there's some people on a Zoom call, and if you have questions, feel free to, shout out here, and we'll do that. But I want to do a couple more, and then I want to talk about the exam itself and we go through some of the issues there. So let's take a look at exercise 12.12. So I want to go down. So this one is and I apologize that I'm going to erase this. So hopefully everyone's got this. If not, I guess it's on video. So I'm going to go ahead and erase this. Okay. And let's do 12.12. And then I think we'll do one more, and then we'll probably talk about the exam and what to expect on that. But in this one, we're going to talk about some issues regarding job order costing and cost absorption. Remember, what this chapter is about is the costing of projects that are unique and different from one another. So, all right. So 12.12 says, Donnelly, let me go there. Let's see. Yeah, okay, that's what I want to do. So, and this is a service industry. So when we talk about this one, and remember, we have talked a lot here about the idea that job order costing seems like it's unique to manufacturing or to construction or to anything which deals with inventory. And I suppose that's true. But it's equally true that we can also apply it to service industries as well. In fact, when I was in the accounting profession, we would refer to our pending tax returns as being a work in process. So it's not terribly different. So if we look at exercise 12 here, and then what have we got going on here? So Donnelly Reuben Associates is a CPA firm, and they use job order costing to capture the cost of its audit jobs. This is an auditing firm. There are no audit jobs in process at the beginning of November. So this is the month of November that we're talking about here. The following data concern the 3 audit jobs conducted during the month. And so the questions here are, number 1, determine the cost of the job. B, indicate the balance in service contracts and process. So remember, service contracts and process is the analog to cost of goods, work in process, but it's used as a sort of a stand-in for work in process, except there's no inventory. And then C, calculate the ending balance. Okay, so let's do this. So number 12.12. So for A here, we're going to do this. We got 3 clients, right? And we have Waters is 1 client. And the second client is Reynolds. And some of this is given, so I'm going to reproduce some of the information that's given here. And then the third client is Bayfield. Okay. Waters, Reynolds, Bayfield. Okay, so what do we got here? All right, so we're talking about product costing, right? In this case, the product is a audit, and what's the cost of each job? Well, remember what the cost of jobs are. First of all, we have direct materials, right, which is given, and direct and labor cost, which we're going to call direct labor. So these first 2 items are really given, so it's no big deal, right? So $600 for direct materials, not much in the way of materials when it comes to auditing, and $400 and 200. So not much in the way of materials. Direct labor is the big piece. And by the way, in a service context, labor is often the major cost. And so in this case, with water, it's 5,400 incurred during November. 6,600 for Reynolds and 3,375. 3,375. Okay. All right, so the big question here is overhead. All right. And it's not really manufacturing overhead, it's overhead that's applied. Okay. So we're going to apply overhead because we're not manufacturing anything, we're doing a service. And so the term manufacturing is really not applicable. Here's what we're given here. We're saying that overhead is applied based on what predetermined overhead rate, right? So we got to look here and say, okay, well, it's based upon $50 per hour. Okay. So this is not labor cost, like some examples we saw before, it's labor hours. Okay. So if you take a labor hours in this case, what do we have here? So we're given the problem that, let's say, waters is 72 hours, okay? And I won't do this for every example here, but if you take the math here, you get $3,600, okay? So overhead applied is based upon an assumption of labor hours, so 3,600, okay, for that. And you do the same, simply taking the hours given times the overhead rate. Now, where did they get that number? I don't know. They got it from wherever they got it. And that's based upon their budgeting process. Okay. And if you capture this all the way across, you're gonna get auditor hours times 50%, and you're gonna get 4,400 for Reynolds and 2,250 for Bayfield. Okay, so if you add these guys up here, what do we end up? We have 9,600 in production costs for waters. Okay. We get for Reynolds, we get 11,400. And we get for Bayfield, we get 5,825. Okay. All right, so those are the costs that we absorbed as a result of this particular transaction. All right, that's part A. All right, and the big trick here is to simply take auditor hours as the driver. Remember, there's got to be activity based times some sort of value, and we don't really know what the value was and how they came up with it. It's part of the budgeting process, and we're going to talk much more about budgeting a bit later. Those are the values that we get as of this particular time. So part B of this asks, indicate the balance of the service contracts in process at the end of November. All right, well, so this is part A. Part B asks, what are the value of service contracts in process? This is relatively straightforward because we're told that the only contract which is not done is this one here. And as a result, 9,600. So it's an inventoryable account, even though there's no inventory, right? So it's kind of a metaphor, this idea that we are producing something, it's not done yet, but we're capturing the cost and we will recover it once we complete the job and sell the good, okay? Or service in this case. An auditing firm doesn't sell inventory, obviously, or produce inventory, they sell a good. So it's the only contract that's still in force. And the final one is calculating any balance of the operating overhead for the year. All right, so all right, here's what's going on. So remember, we talked about applied overhead and how we get to this idea of product cost. One of the ways we do it is by dropping costs on individual jobs. And why do we do that? Even though there are variances that end up in cost of goods sold, positive or negative, why do we do this? We do it so we can attach these to individual jobs themselves. Okay. So in this case, so that we can determine whether or not that job or that customer or that particular project is profitable, not profitable. Should we do more of it? Should we do less of it? Whatever. In this case, in part C, what are we being asked here? We're saying calculate any balance of operating overhead. So, all right, well, we've applied overhead here in this case. The actual, as it's given to us, the actual overhead is 11,000. Okay. So we know that, so 11,000 is the actual overhead. So remember, estimated or applied overhead is just an estimate sort of given, it's estimated at the predetermined point of origin here. In this case, we're saying, what do we apply? So we apply 3,600, 4,400, and 2,250, which is the applied overhead. Applied is simply estimated, but it is dropped on these projects, so 10,250. And the difference there is 750, and that is under applied overhead. So what do we do with under applied overhead? If we have under applied overhead, it means we have not recognized enough cost. I'm cutting down here. Under applied overhead, so we've not recognized enough cost. So what do we have to do in this case? We have to make it a difference, and we do it by raising cost of goods sold because our estimates were a little bit wrong. And let's not think that our estimates are being wrong or any big deal at all, because it is the case in which we often are off in our estimates, and this is really part of management. It's the idea that we're making estimates, we're budgeting for things, and they may or may not be accurate. In this case, we're off by $750. Is that a big amount? I don't know. It really depends upon management's preference. So in this regard here, this is part A, B, and C. The idea that we are trying to account for overhead as well as the cost of production, and this kind of gives us an idea of what we're looking at. Okay. All right. Questions about this one? Okay. So, all right, ready to talk about the exam? Is that are we ready to do that? So the exam is this week, and you want to make sure that you're up and ready for that. And so let's talk a bit about that, and let me kind of do some moving around here, and I'll go through some of the requirements of the exam itself. So. Okay, so the exam is available. It's available now. It's available on Sunday or Monday morning, and it's available through Sunday evening at 11:59 p.m. Yeah. So let's talk about what is going on. And if you have any questions, feel free to reach out. It's no big deal. Okay. So here's the exam. So it's 35 questions, 35, and they're all multiple choice. So the answer is there. Obviously, it requires some calculations. So 35 questions. You have 90 minutes to do the exam, and you have one attempt. And this exam itself was sort of created by consensus, and the department itself got together and sort of chose the parameters of the exam: 90 minutes, one attempt, etc. It's not a bright space, so you don't show up anywhere. You can do it wherever you want to do it, and it's going to cover the first 3 chapters that we covered in class in this semester. So chapter 10 dealt with mostly financial accounting issues from the sort of leftovers from 2110. Chapter 11 sort of introduced us to managerial accounting and some of the concepts inherent in that. And chapter 12 specifically job market costing. So let's do some examples here of what we're looking at on this exam itself. And if you have questions, feel free to hit me with them. I'm more than glad to talk about it. So, okay, so in chapter 10, remember this chapter 10 was this interesting chapter which sort of took us back to accounting 1, 2110. It was a leftover, and we talked about ratio analysis. Now remember, there are 3 main categories of analysis that we talked about in chapter 10. And I'm just going to list them right here. So you got it. Okay. There are 3 main categories of analysis. First of all, there's horizontal analysis, which is also known as time series or time analysis. So horizontal analysis. There is a vertical analysis, which is also referred to as common sized analysis. And there's also ratio analysis. And ratios are simply a way by which we compare one value to another. So those are the 3 main sort of learning objectives in chapter 10. Okay. So what are we talking about here with regard to these particular topics here? So if we're talking about company comparisons maybe within the company itself, we're probably talking about what we call intra-company. Know the term intra-company versus inter-company. One of the things that we can use financial analysis for is to compare one company to another or one company's performance within the company itself, intra-company. So you kind of want to know what that concept is about. And there are really a number of questions dealing with this idea of ratios and how we compute them. And so you want to know about these three topics and what they are in terms of how we're defining them and what's being covered there. One of the questions deals with, which is not an element of analysis here. So that's pretty straightforward if you know what these are all about. So also, we talk about horizontal analysis. What are we talking about here? We have years, so 2019, 2020, whatever, across the way. We're also calling this trend analysis. Okay, trend analysis. This is what financial analysts tend to do: is try to track the movement of variables on all these particular accounts that are reported on balance sheets and income statements. They're trying to get an idea of what trends are happening. So horizontal analysis, also known as trend analysis. Okay, and there's a question, and I know accounts love this, and this is a question dealing with the idea how we arrive at the percentage change in anything. Okay, and I went over this a bit before, but let's do it again. All right, and this is a question that just bugs people in the business world all the time. Whatever you're doing to try and arrive at a percentage change, you're taking the new variable, whatever it is, minus the old variable, and it's always doing the old variable. Okay, so whatever it is. So if you've got whatever these numbers are, so 120 is the new variable, 100 is the old. We divide by here. We get 20 over 100. We get 0.2, or if we move the decimal 2 points to the right, we get 20%. Okay. But the key thing here is to divide by the old variable. That's a very often missing thing. So, and what we're getting at here is the percentage change in something. Okay. Your mind's sold overall. Always. It's going to be that. And this is obviously a very simple example I taught about here, but it's the idea that we're trying to get something very simple. And what is the methodology we use to get there? Okay. And so you have one or two questions on the exam dealing with this. It might be dealing with something with regard to income or whatever the case might be, but nonetheless, it's going to be the same methodology we're applying here. Okay. Also know that so if we say that horizontal analysis is trend analysis, when we go across the time frame, what is vertical analysis? It's more based on this idea of common sizing, and it's more this idea we talk about common size analysis. So what is common sizing? Okay, so remember there are two major statements on the in the balance sheet income statement. So when it comes to the balance sheet, right? What is the value that we're keying off of? The balance sheet, we're looking at total assets, and everything is as an expression of total assets. 100% or 0.1, right? Or 1.0, right? And the income statement is the other major statement. And in this case, the value in question here is the net revenue, net sales, net revenue, what the case might be. That's 1 or 100%. So everything is expressed as a percentage of those guys. Now, net sales, I wouldn't get too bent on shape of what net sales is. Net sales is basically gross sales minus returns and allowances and discounts and whatnot. This kind of goes back to 2010. Not a big deal there, okay? And that's what net sales is.
So
but that's go ahead.
Sorry, the balance sheet is the one you sent as the snapshot, and the income statement is the video, right?
Yeah. So balance sheet does what? It's a snapshot. So think about this. We have 4 major financial statements. in financial account, we got the balance sheet, income statement, statement of retained earnings, and statement of cash flows. And we're not really going to cover the statement of retained earnings or statement of cash flows at all. But the metaphor that's been used is the balance sheet is a snapshot, like as of a certain date. So the balance sheet is as of 12/31 if we're using a calendar year. Income statements 1/1/12/31. Whatever those years are in question. Okay, so the balance sheet is a snapshot. It's like a click. And what we're doing is we're simply freezing things and reporting our balances as they are. Income statement is more considered the motion picture where we're starting on January 1st, we're rolling all the way to December 31st. Okay, so that's what's going on. So common size, and so common size analysis basically says what? Okay, every value on a balance sheet is linked to as a percentage of total assets. Even if it's not on the asset side of the balance sheet, right? Even if it's on the liability side. Because remember, we've got on the balance sheet, we got total assets and we have total liabilities plus stockholders' equity. They're all common size as a percentage of total assets. Okay, so that's what's interesting here is the idea that we are linking everything to total assets. And then what's really, I think, probably not brought out as well in the text as it should be is the idea that we can use both vertical and horizontal analysis in order to determine what's going on here. So if current assets have gone from 35% to 21% year to year, why is that? What's going on? Why are we doing that? That's a question. So both of these sets of analyses can be used in combination with one. And they very often are. Yeah. Okay. Questions so far? Okay. And so we talk about 100%. Where does 100% figure come from? It basically comes from the idea that we're taking on a balance sheet, everything is related to total assets, and everything on the income statement is related to net sales. And why are we looking at net sales? What's important about net sales? It's the idea that we're taking out returns and allowances, which don't really count at the end of the day, because these are goods that customers have brought back or returned. So those don't count. And any discounts on the sales obviously don't count for revenue. So those are gone. So those are what we hang our hat on in terms of the common size statements. All right, so also in chapter 10, we had 3 different kinds of ratios, financial ratios, and they go in 3 categories: liquidity, solvency, and profitability. I know what those are, basically. So remember, liquidity has to do with the ability of a company to meet its short-term obligations, current payables of suppliers and whatnot, wages payables, payment obviously, and taxes payable. Solvency is more of a long-term issue. Can this company maintain its earning power to pay off its debts in the long term? And then profitability really refers to this idea of how profitable the company is. And that really relates to both short-term and long-term. So liquidity, solvency, and profitability. And then there are a number of questions in chapter 10 dealing with what some specific measures of profitability are, or what all these measures are. So in terms of liquidity, what are some of the measures we use to judge liquidity? Asset turnover, accounts receivable turnover. Accounts receivable turnover is simply the sales divided by accounts receivable, the average receivables. It tells you how many times receivables turn over. And that tells you how quickly throughout the accounting period receivables are being paid. That's a measure, a short-term measure. Inventory is the very same way, it's the very same measure. And we use the issue of average inventory in order to determine what's going on. So those are what's going on. So you might want to take a look at that and see what's going on. In the case of, let's just look at accounts receivable turnover. So what is going on here without doing both accounts receivables and inventory turnover? So what is the inventory turnover, let's say? So these are accounts receivable, right? And in accounting one, we talked about the idea that we're talking about credit sales, right? Because obviously sales not on credit wouldn't be involved here. Divided by average accounts receivable. An average accounts receivable on what? Okay. So this is a dollar figure here. And a dollar figure there, okay? Divided by, and so what is average accounts receivable? It's the beginning accounts receivable plus the ending accounts receivable. And all that divided by 2, and that's the erasing this here. And that kind of gives us an idea of what we're doing with this. So why do we do this? Remember, this is a methodology that we use in average. So we take credit sales, those are goods which are sold on a credit, which we create a receivable. Remember, we sell a good, and we collect cash, or we can bill the customer. And so in this case, we're billing the customer. That's the whole point of accounts receivable, is to determine how quickly we turn these things over. So we're billing the customer, and as a result here, we're asking ourselves, how quickly are we collecting this? So credit sales has a dollar here, beginning and ending, and divided by 2. Okay. And then again, it's going to give us some kind of number. Maybe it's 8. Okay. Well, let's say it's 10. Let's give them out. Let's say it's 10. That gives the math simple. Then we can take 365 divided by 10, and that gives us 36.5 days by which we collect the receivables. And that may not be good, bad. It's probably okay, I would imagine, in most cases. So that's what's going on. That's one ratio in the liquidity area. Liquidity deals with this idea of how quickly can a company raise cash to pay current debts. And that's what's going on. Accounts receivable turnover, inventory turnover, all pieces of that particular puzzle. Okay, and when it comes to profitability, so remember profitability. So remember, we have 3 categories of ratio analysis. We have liquidity ratios, liquidity, solvency, and profitability. So when it comes to profitability, we have 2 main ratios. We have ROA and we have ROE. Okay. And we always said that ROE is always going to be greater than ROA unless the company has no liabilities at all, right? So what is going on here with these 2 ratios? This is net income divided by average assets, net income divided by average stockholders' equity. ROE is always going to be greater than ROA simply because of the fact it's got a lower denominator. So know what ROE really is. ROE is the way to think about ROE, I think, is the idea that when you have $1 to invest, and ROE is something greater than what you can earn on a savings account or a bond or whatever, then that may be a thing for you. Obviously, you have to take into account a lot of other things. But that's kind of the logic that applies to ROE. These are expressed as percentages. So profitability measures are really expressed as percentages, and that's really the rule of thumb here. Is the idea we're talking about return on investment. Yeah, hence the R in that. Okay. All right, so that's an example of one of the cases you might see in the exam itself. Let's see here. Okay, and all right, so and you might see this particular kind of analysis here. And so what I did here was accounts receivable turnover. We had credit sales in dollars and average receivables in dollars. And I did the math and I got some kind of number. And I said it was 10. Okay. The same logic applies to inventory as well. Okay. Only inventory turnover is cost of goods sold divided by average inventory. Okay. Cost of goods sold, and without wasting time there, it's cost of goods sold divided by average inventory. And the average of anything in this class is beginning, which always is the ending value from the prior period, plus the ending, which is probably given, divided by 2. That kind of smooths out or it's thought to smooth out the fluctuations throughout the year. Whether it does it or not is mostly irrelevant. And that's what's going on with inventory. And what is that question asking us to solve? It's asking us how many times inventory turns over in a year. So receivables turn over 10 times a year, okay? And we don't have it in 365 because it's 36.5 days by which receivables are collected. Well, inventory is the same concept. How to look at this inventory and move. And this is an important measure here because a lot of companies really try to move inventory quickly. You know, the bigger retailers, Walmart, Costco, Home Depot, they try to move inventory quickly. And so know what some of the categories of ratios are. So know what, I mean, we talked about liquidity, we talked about current ratio, we talked about profitability, we talked about ROE, ROA, solvency, we talked about debt to assets, debt to equity. Just know what these ratios are. Just kind of be familiar with them. And it is not a deep dive at all. Just kind of be familiar. And as you do the exam itself, just kind of have these resources available to you so you can sort of know what's going on. One of the biggies is this idea of profitability, okay? And net profit margin. So the term margin implies a percentage. And so we're talking about net profit margin. What we're really talking about is net income, however it's defined here, divided by net sales or net revenue, okay? And you're going to end up with some percentage. So whatever that is, it's going to be some percentage. And this is a net profit margin. This differs from the gross profit margin. Because remember what gross profit margin is. It's going to be revenue, net revenue, minus cost of goods sold over net revenue. Or net sales, and by the way, just kind of be familiar with the term net sales and revenue being the same thing. And you're going to get some percentage there, okay? So remember, if we go back to accounting 1, where we had 3 stages of the balance sheet, we had the top section, sales minus cost of goods sold equals gross profit. Well, this is what gross profit is, net revenue minus cost of goods sold, right? Divided by net revenue, it's going to be a percentage. In the case of gross or net profit, that's gross profit. Net profit is net income divided by net revenue, okay? This is net, and so what is net income? And I know that we get a little bit confused here because of the fact that we sometimes give it a tax and sometimes not tax or et cetera, but it's the idea that we're taking the bottom line divided by the top line, and that gives us a percentage. Okay. There's a question about managerial accounting, what it is, and managerial accounting is this idea of internal documents prepared for primarily management. And it could be anybody in management. It could be HR, it could be IT, it could be anybody who's got a need for that particular information. So you want to kind of know what managerial accounting is. And also know, we talked in chapter 10 about this idea of how we differentiate managerial from financial accounting. We said managerial accounting is internal users. And who are the external users, right? That we covered it in accounting 1. External users are shareholders, lenders, regulators, unions, whomever. So kind of know the difference between internal and external users. And remember that in managerial accounting, we don't prepare statements according to GAAP, right? These are not GAAP formatted, even though sometimes it looks like that. It's not what we're trying to do here. Okay. Trying to give you a bit of an overview as to what to expect in this game. Okay, and know about the functions of management. So we talk about organizing, planning, and controlling, and organizing, planning, and directing. Those are the management functions that appear in chapter 1. So know what those are about, know who's involved, also know about the structure of management and what the top level is, board of directors, CEO, then the functional areas that fall below that, so kind of know what that's about. And that's an example of content coming from chapter 11. Okay, and also we talked about costs of production. And we talked about the product costs, which we said inventoriable, they're also manufacturing, direct materials, direct labor, manufacturing overhead. But no one goes into those particular categories, particularly manufacturing overhead. What are we talking about? The manufacturing overhead. We're talking about those costs which can't easily be tracked down, traced to the good itself. Or if they can, they're very small and difficult to trace. So kind of know what goes into this concept of overhead, because overhead is one of the trickier subjects that we cover earlier in accounting. Okay. Questions so far? And also know about the difference between period costs and product costs. So remember, we talk about period cost, a product cost. It's all these costs. It's direct materials, direct labor, it's manufacturing overhead. And period costs are so named because they're simply collated, collected, aggregated at the end of some accounting period. There's salaries of salespeople, or administrative staff, whatever. There, it's depreciation on tables and chairs in the home office. They're not directly related to the cost of goods itself. Okay, so period costs are those which are unrelated, and we'll talk a bit more in a second about some examples of costs which are not included in inventory costs. So remember, the key thing here is the idea of product costs or manufacturing costs have got to be absorbed in inventory. And that's the key element of what we're doing here. Yeah. Okay, cost of goods manufacturing. So let's talk a little bit about this. So there's a question or two or whatever dealing with cost of goods manufacturing. So in general, let me go erase this. I want to give you a bit of a head start on this. Okay, so remember what cost of goods manufacturing is. If you look back in the text, in chapter 12, there's a discussion about cost of goods manufacturing. And it's the analogy to a merchandising firm buying finished goods. But these goods aren't finished in the case of manufacturing. So we've got to put these goods together. Okay, so and so remember, when we talk about manufacturing costs, let's just sort of break these out. We're talking about direct materials, direct labor, and overhead. Okay. But remember, when direct materials are involved, we're talking about raw materials that are sort of beginning, right? Plus the purchases of raw materials. Because you've got to sort of suss out the cost of raw materials. And then you take out raw materials that are ending. If you add to that, then direct labor and manufacturing overhead, and you should arrive at manufacturing costs. This is not cost of finished goods, because this is cost of what we did during the year. Yeah. So kind of look at that as a sort of a cheat sheet. Because there's a question dealing with this idea of how do we get to manufacturing costs? Well, keep in mind, we've got to account for raw materials, but it's only raw materials that we use, right? So, and we go back to this idea, this methodology that we say, we start with something, we add more things, we take out the ending things, we get what's done during the year. So raw materials, beginning raw materials plus raw materials purchases minus ending raw materials gives us raw materials, right, for the year, used during the year, plus direct labor and manufacturing gives us manufacturing costs. And those are the things that we ought to be really thinking about. Okay. So those are the things we ought to be including in our analysis. Okay. Also, we've got this idea of how we get to cost of goods sold. Okay. And I want to do one thing here because we're sort of running low on time. I'm going to erase this over here. Cost of goods sold, because remember, cost of goods sold is simply the cost of goods which have been transferred to the buyer, and hence all the inventory costs are now recognized as expense on our income statement. Okay, so we talk about what's going on here. What we're really getting at. we're talking about beginning finished goods, right? So beginning finished goods. And we're talking about the cost of goods manufactured, which is the production cost, minus ending finished goods, right? Whatever the accounting period is, the ending finished goods. And we have cost of goods sold. Okay. Remember, cost of goods sold, we talked about this in accounting once, the idea of what is the cost of goods that are already been sent out the door. In this case, we can only sell finished goods, we can't sell unfinished goods. So try and track the beginning plus the new goods. And remember what the analog of this is. In a merchandising context, it would be purchases of finished goods. In this case, we're making the goods. And so this is a big category in its own right, right? Because we got to account for direct materials, direct labor, manufacturing, everything. But nonetheless, we put these together and we subtract ending finished goods, we get cost of goods sold. So kind of know those two formulas, those are right things. They're going to be helpful to you as you my time is somewhat limited here, so I'm going to kind of move as quickly as I can here. So, and so know what cost of goods manufactured is. Cost of goods manufactured is simply the cost of producing goods all the way from start to finish. It's very analogous to this idea of purchases in a merchandising context. And then chapter 12 deals with job order costing. I know we're about out of time here. I'm sorry that we're a little bit late, but maybe you'll bear with me. So job order costing differs from process costing in the sense that we're attaching costs as we absorb costs all the way through to some finish on some unique output, whatever it is, some particular job, whether it's a construction project or remodeling or whatever. It's unique to that particular job, as opposed to what process costing, where we're producing hundreds of thousands of goods over a time period, and we're capturing the costs and dividing by the units. That's a little bit different. This is more unique to what we're doing. Okay, so that's important for us to know.
Tim, sorry, what's that word you've got? Raw material beginning plus raw material
Purchases.
purchases.
Yes. Sorry.
It's okay.
I'm trying to move quickly here, and I'm making mistakes. I think so. Okay, so and when we come to job order costing, just know what the issues are with job order costing. Where we accumulate costs on a job cost sheet, which may or may not be a piece of paper, but maybe some sort of record in which we're capturing those kind of things on, and kind of know what types of jobs might be applicable to job order costing. We talked, and I know your textbook likes to talk about cereal and producing thousands of boxes of cereal. That's process costing, but something like custom cars and remodeling or whatever, that would be more akin to job order costing. Yeah. And then know about the cost accumulation process, which kind of goes really across all of these. And in particular, know about raw materials. So one thing about raw materials is this. Raw materials is not, it's simply an account that is a place where we put purchases of raw materials, but they can go to direct materials or indirect materials. Okay. So we assign an inventory when we know what jobs they're applicable to. And that's the key thing in job order costing, is that we assign costs, whether it's direct materials or direct labor, to the costs or to the projects once we know they're allocated to them. And one of the examples I used was a painting contractor where there was a bunch of paint and all kinds of supplies. And we allocate those to the particular job once we know what job we're doing. Okay. And I'm about out of time here, and I apologize, I'm running a little late. And I don't want to keep you guys too long here, but I just a few more things I want to go over here. Also, we talked about this idea of labor. And what goes into labor costs? It's not just the wage, it's also things like benefits and payroll taxes. Remember, payroll taxes are paid by the employer. So as well as the employee, Social Security, Medicare. So if you have an employee, you pay them $10,000 a year, you've also got to pay their social security as well as the Medicare, so those are costs which are included. Okay, and then kind of know what costs are absorbed generally into to manufacturing cost itself. So anyway, I'm about out of time. I don't want to go over because I can't really keep you guys later, but this is kind of an idea of what to expect on the exam itself. So it's available now. It's available through Sunday. And if you have questions about it, let me know, and I'm more than glad to go over any of them and have to discuss that. So okay. All right. So good luck on the exam. See you next time.
So you have office hours now, right?
Not today.
Not today?
Not today. I do.
Okay. You do.
I do. Hold on a second.
Where? Can you tell me what room that's in?
Yeah.